Good morning. Today is Halloween. It's Monday, October 31st, 2022. Almost down to the final 2 months of the year. Tom, how are you doing?
I think I'm ready to close the book on
It's been a year, man.
2022. But
It's been,
hope springs eternal. That first week of the new year always feels pretty good. So I'm hoping that next year will be stronger than this year.
yeah. Well, if we shall see. One group of people who don't hope that next year will be good is our Federal Reserve Chief, Jay Powell. He is not happy with how much consumers continue to spend. He's not happy with how much savings consumers have, and the fact that prices have been persistently high. His mouthpiece, Nick Timiraos, who works over at the Wall Street Journal, is really out front ahead of the Fed meeting this week. Actually, he was tweeting a lot on Friday. He came out with an article Friday evening, and then he was on all the Sunday shows, or at least Face the Nation on Sunday. And then this morning he came out with another Wall Street Journal article. So he's been all over the place. And I think the key thing is something that he said on Face the Nation. And this is ultimately gets to the point of everything that's preceded this. And that is, if consumers keep spending the savings they've accrued during the pandemic, then that means the Fed is just going to come in and raise interest rates more. Jay Powell is going to get on the phone and call the cops and say, we need to get the noise volume down. We've got to get these people to go home because it's just not sustainable to have inflation to continue to go higher and higher and higher. And basically that's the point, is that whether or not the Fed does 50 basis points in December, it looks likely that we're going to have continued rate increases into 2023. And this is something that we've talked about. You just don't magically turn the calendar into a new year and then immediately stop rate hikes. And I think that's the piece that the market has to grapple with. I think going down to 50 basis points will get people a little bit more excited, but it's going to be this persistent pressure on the market. And right now, the problem is inflation is going up, not down. And I think the Fed is quite concerned about that. But at the same time, they realize that if they raise interest rates much faster than they are, they're going to absolutely destroy interest rate sensitive sectors like the housing market.
Yeah, they're really in between a rock and a hard place. And I think what's interesting is tell me what you think about this, Ben. I think what was happening, maybe call it 10 days ago, was that Jay Powell was feeling pretty good about himself, thought, man, this market's really rough. Interest rates are going higher. We're getting some real traction. And then he's like, we're going to get these terrible tech earnings reports, and it's going to just absolutely wreck the market. And then that's going to cause inflation to go down. It's going to cause everybody to start reassessing what's going on. And then GDP came in strong. The GDP now estimate already for Q4 is at like 3%. I mean, we're seeing no progress on inflation. And so he had to turn around and go back to Nick Timiraos and be like, we need to, basically rejigger this entire messaging. Because last week Nick Timiraos is the same person who basically made the market go skyrocketing when he basically said the Fed is going to pivot, only to have the Fed turn around and see the data and say, oh man, we're definitely not going to pivot. That being said, the futures have come down for the December hike down. It's really more like 2.5 right now. We've come way back, so 3 is not a guarantee for December, though I would argue that it's probably going to happen either way. But we're still in this like weird amorphous thing where the Fed can't figure out what they want to do. They keep telling their mouthpiece different things. He turns around and writes Wall Street Journal articles all week about the pivot, then has to turn around and pivot himself and spend the whole weekend on Meet the Press telling everybody that the rates are going to the moon. So the question is, what is going on? My expectation, as always, is going to be we need to prepare for higher rates, because that's the one that's going to hurt us. We shouldn't be preparing for basically a pizza party that may or may not come. You need to be working on protecting yourself from the downside, and I think that's what we've got coming down the pike.
I think you bringing up the earnings reports is very interesting too, because Timiraos was actually talking about that. He talked about it on Face the Nation. He also talked about it in the Wall Street Journal article, saying earnings reports from companies including United Air, Bank of America, Nestle, Coca-Cola, and Netflix also point to strong consumer demand and pricing increases. And then he finally says, and this is what he said on CNBC on Friday night. He says that it feels like the stopping point for rate increases is getting pushed out further in the calendar as the economy continues to show a fair amount of resilience here. And ultimately, he's talking about wanting the Fed to induce some sort of a recession. The problem is they're not really getting close to that, and they need more pain, and they need to constrain the economy a little bit more. And so that's what they're trying to avoid. They need to continue to tighten the screws on financial conditions while at the same time not destroying the plumbing of the market. And I think that's the conundrum that they have. Meanwhile, in Europe, we got Euro area October consumer price inflation today, and that just accelerated to a new high on the headline number. That's now 10.7% for the Euro area as a whole. The last reading for that was 10%. That's 0.5 higher than expected. And we throw this 0.5 higher than expected out, and it doesn't sound that much when you're talking about 10% consumer price inflation. But bear in mind, we had unbelievably easy monetary policy in the US, in Europe, and in Japan for years because we're at 1.7% inflation, which was lower than the 2% target. And that was unacceptable. And now we're missing estimates by 0.5%, and we're at 10%. It's hard to fathom in some respects. You have core inflation at 5% in Europe, which incidentally is actually lower than it is here in the US. Where Europe is really getting killed is on the energy piece of that. And so it'll be very interesting to see what happens in the months of November and December, especially now as we're beginning to work through the end of the SPR releases. I mean, beginning now, the SPR releases are pretty much done. You're going to have the OPEC cut hitting. Oil prices did move a little bit last week to the upside, and they're coming back a little bit today. But I think that on the supply side, you're definitely having some more oil come off the market. So I think you put all this together, and if you're Jay Powell at the Fed and you're hoping that you'll have some grasp on inflation by the end of the year, I just think that the path forward for that is fairly unlikely, both for Jay Powell and the folks over in Europe.
Yeah, I just wanted to point out a couple numbers just on that CPI in the Eurozone. Andrew and I had lunch with a client last week, and we were trying to explain that, like, not only is the overall number probably lower than you think, but they're anchored specifically by, Germany and France, who have much lower inflation than the rest of Europe. I mean, some of these numbers are ridiculous. Netherlands came in at 16.8%, and that's on an estimate of 16.5. And then you've got Austria coming in at 11%. I mean, you've got high double-digit year over year CPI numbers in a lot of these countries. Poland, again, same thing, very, very high. But you're not seeing those numbers because they basically harmonize them together and say, hey, the Eurozone, is roughly, 6%, yada, yada, yada. But if you look around, some of these countries are getting absolutely destroyed by inflation. And that number gets pretty, it gets basically erased out. Everybody kind of gets in this one big bucket, but, it's kind of like the S&P 500 where Apple is, roughly 7% of the S&P 500. Germany is probably at least 7% of that Eurozone inflation number in terms of a weighted average. And so it's really bringing it down much lower than, you'd actually really be realized in some of these countries.
The European Monetary Union is so poorly conceived, I think, precisely because of that, Tom, because you have different dynamics working in different countries, and yet you have one single monetary system for them all. It makes it easy to travel from country to country or pay in the currency, but it makes it very difficult to actually manage monetary policy. I think in terms of an overarching social ideal, the European Monetary Union, the European experiment in general, is extremely attractive. But in terms of how to actually get a monetary policy effective and done, it doesn't seem to be the most effective way to do it, to be done in such a centralized manner.
Yeah.
You have to be a little bit more decentralized. What's interesting too is Scotland is thinking about wanting to join the European Union, and what they said is, don't even try unless you're going to become part of the European Monetary Union.
Yeah.
If I'm Scotland, I don't really want to do that. I mean, I don't know if them being part of the British pound is any better, but having the same monetary authorities make policy for Scotland as they do in Poland just seems misguided to me.
Yeah, it'd be like, the difference would be like Texas and Hawaii, right? They both have their totally different economies, totally different demographics. One is an island, one is a giant state. They don't need to be managed exactly the same way. And because of the state system, obviously we manage each individual state at a local level. And you're not getting that in the Eurozone. I mean, Netherlands is tiny. It's a chain of islands. They're underwater, functionally. And then Germany is a massive, mostly landlocked, mega country that's not anywhere close to them. So I would kind of think of it that way.
Staying with the geopolitics, Lula beat out Bolsonaro to win the Brazilian presidency. He's 77 years old. This is a guy who just won't leave the Brazilian political scene. He's been there since the early 2000s and really presided over a fairly good period for Brazilian economic growth. He's very much left of center, and Bolsonaro is very much right of center. And I think that a lot of people harken back to those days of 2003 to 2010 and really look on Lula very fondly. He was much more towards socialism, which is easier to do when your country is crushing it. And when China's going through a commodity super cycle and prices of iron are going up and prices of agricultural goods are going up, and oil and Petrobras is making gobs and gobs of money. There's a lot of money to go around because you have such a stepwise change. I question whether he'll be as effective this time. He also has the Bolsonaro government actually retained a lot of places in Congress, but Lula had also been in prison for 3 years because of corruption, and he would have been in for a lot longer, but it was released on technicalities. So very interesting political situation there in Brazil. I'm curious to see how it goes. I wouldn't be surprised to see Brazil become a little bit closer to China, but I don't expect the same prosperity that they had in the early 2000s.
Yeah, I mean, it doesn't bode well given that the BRICS have all sort of decided to lump in together. You got Brazil, Russia, India, China. I mean, from a population standpoint, should they decide to link up and start some trouble, we would have been in a real problem. But I agree with you. I mean, back in 2013, 14, I had a fair amount of Petróleo Brasileiro bonds on the books, and then when that whole scandal came out where Petrobras got dinged for corruption, it was a little hairy there for a minute, but we managed to get everybody out and make some money on those bonds. But it was not my favorite time for Brazilian politics, that's for certain. So I'm interested to see what happens, ushering sort of a new era, old era back into Brazil.
Good looking ahead for the week. Tuesday, tomorrow is going to be a little bit of a healthcare day. We have Pfizer and Eli Lilly both reporting earnings. That'll be interesting to see how Pfizer's doing on their big COVID push and how Lilly's doing with their new drug. And we did talk about that at the macro. Looking at weekly scripts, interestingly, just as a quick thesis update on Eli Lilly, they're now at 130,000 scripts per week, which has accelerated actually over the last couple of weeks. So I think when we talked about it, maybe it was 80 or 90,000. So we're seeing really good script numbers. So we're talking about well over 500,000 scripts per month for that diabetes drug, which has been shown to demonstrate some good weight loss, especially in those studies. Wednesday is more of an aggregates day. We have both Martin Marietta and Vulcan Materials reporting, and then Wednesday night and into Thursday, we'll have some more of the semiconductor companies with Microchip and Skyworks and Qualcomm and Qorvo all reported earnings. So another pulse check on that sector and how well smartphone sales are doing with those chips. But it's really going to be a big economic data week. We have the job openings report tomorrow. We have the ISM manufacturing report on tomorrow and the ISM services on Thursday. We have a big employment report on Friday. But before all that, we have the Fed meeting tomorrow, Tom. And I think all eyes are going to be on that. There's going to be a lot of volatility associated with that, I think. And even more, I think everyone expects them to raise by 75 basis points. Question is, what is Jay Powell's tone? And this is going to be something that guys like Nick Timmerose, all these economists at these big banks are going to be watching, and they're going to be trying to decipher the word choice that Powell makes in his press conference, because that is going to dictate where markets go maybe over the next 2 months.
I would expect him to be on the fiery side, almost like the Jackson Hole Jackson Hole was over the summer. It's the, big federal, hoopla that happens during the summer every year. And everyone was expecting him to wax poetic, put together a big speech, and he spoke for 9 minutes. And he had a pretty terse, just sort of grumpy tone. And I would expect that this week. I think he's just going to be like, listen, it's not going the way we want it to. We're going to have to get real aggressive here. We're raising rates. We're looking at all the data, but the data's not coming back the way we want it to. And we're going to have to really, I think he's going to try and shake up some fear. I think he's upset. And justifiably so, because the way this trend has gone is that people think the Fed's going to pivot, stock market goes up, people feel happy, people start buying stuff, they feel a little more secure, demand goes up, inflation goes up, all these companies do well, and it becomes this, economic sort of becomes a self-fulfilling prophecy. So he wants to inject as much doom and gloom and unhappiness, because then maybe people won't spend their money and people will bring down demand, bring down economic activity, bring down the jobs market, and maybe he'll make some progress on the inflation number.
I agree, Tom. I think that he is going to, and my question is, do you think he demonstrates any humility? And by what I mean by that is I think that he will admit that he hasn't had the progress on inflation that he had hoped. But will he be a hammer in search of a nail and just keep saying, hey, we got to keep our foot on the pedal and keep going with these interest rate hikes? Or will he say, we need some help. We need some help on the fiscal side here. We need some more tightness. We just can't keep raising rates because it's not working. So will he just keep going because that's what you do? Or will he actually say, we're trying, but we need to try some other things too?
The latter seems pretty unlikely to me. I mean, even in the face of inflation 2 years ago, he was like, well, it doesn't look like much to me. Oh, it's transitory. Oh, there's no way this becomes sticky. So a willingness to admit defeat and or a change in tactics is not in the Fed's playbook. It's not their first thing to go to. I would expect them to continue on this path for quite some time before they admit that they have had very little impact on markets in terms of the inflation rate, GDP, jobs market. I mean, it was just, the writing was on the wall 18 months ago that this was going to be a problem. They chose to ignore it. They chose to willfully ignore it. It created a credibility problem. And now I think that they're in the same boat. They're thinking, we raised rates, it's way more than we thought we would. It's having no effect, but it should have an effect. So we're going to keep trying until it does have an effect. That's that's what I think. Who knows? He could say anything. I thought he was going to talk for 2 hours at Jackson Hole. So could be wrong.
And so on that note, we'll leave it there. I think just the big takeaway from us is that from a portfolio management perspective, we are operating under that lens. We're not thinking that they'll pivot. We're not trying to jump onto the train of last week. We'll probably fade that train. And I think that's what we've been trying to do at the margin. So with that, we'll leave it there. Have a great Halloween, safe Halloween, and we'll see you here in the month of November tomorrow morning.